pip is a unit of measure we use within financial markets. So for example, the unit of measure you use for distance would be kilometers, miles. In the market, we use pips, and pip stands for percentage in price. Sort of measure how much pips you're making based on your lot size, which I'll speak about later. Understanding what a pip is very important when trading. So understanding what a pip is vital to becoming a profitable trader. So if you've put in a buy you want the market to go up. If it begins to go down, you're going to start losing money. So your stop loss will take you out of the trade at a predetermined price in order to protect your account and protect your equity. Using a stop loss is very important. Please trade with a stop loss. Do not trade without one. Every profitable trader uses one, because you need to understand that you cannot win every single trade. You're going to lose some trades, and if you are using a stop loss, you're using risk management, which is key. So for example, if we've entered trade within the community, say we've sent out a buy on gold, and the buy would be at 3815, we'd have our TPs and we'll have our stop loss at say 3810. So that is 50 pips away from 3815. You're risking 50 pips, and depending on the size of your account and your lot size, and it's very important in trading to understand what you're risking when entering a trade. So setting break even is very important. It's something we advise our traders to do in profit. So let's say you've entered a buy again at 3815. Let's say the market's moved 50 pips to 3820. Your trade is 50 pips in profit. Where your stop loss was at 3810, you want to now go into your MetaTrader 5 and you want to change your stop loss from 3810 to 3815, which is your entry price. So if the market does come back down to 3815, you'll be taken out of the trade at break even. So TP stands for take profit, and it works the same as your stop loss, except it will take you out of the trade in profit. So we're all busy. The market is very, very volatile. You don't want to be sitting there all day looking at. So if you set your TP, we'll use our trade again, our gold buy at 3815. Let's say your TP set at 3825. Once the market moves to 3825, you will essentially be taken out of the trade at 3825, so 100 pips profit. So following what we've just spoken about, stop loss, TP, make sure at firstly you don't lose too much money. You're going to lose trades, which is fine, but you always want to be making more than you lose. And as long as you're doing this, there's no doubt you'll be profitable. Once you've entered a trade, it would show the price that you've entered at. Now, let's say, for example, you've entered at 3815 and the market comes down to 3813, which is 20 pips below 3815. You can choose to enter again if your risk management plan allows. You can choose to enter again 20 pips in drawdown. So this is essentially layering. This is going to amplify your gains, because when your TPs at 3825 get hit, you're going to make essentially more profit because you've entered twice, you've layered that trade. Now, we normally advise to layer 3 to 4 times, no more than that. And what you can do, you can break down your lot sizes in the layers. So let's say your total lot size is, let's say, 0.6. So instead of entering 0.6 once at 3815, you can spread the 0.6 into 4 trades. So you can enter 0.2 at 3815, you can enter another 0.2 at 3813, another 0.2 if the market comes down to 3811, and then obviously if the market moves within your favor, then you're gonna make more money, and this is a way to amplify your gains and make more profit. But again, only do this if your risk management plan allows. And this actually brings me on to the last topic, which is lot sizes. I mentioned 0.6, 0.2. Now, what does this mean? So on your MetaTrader, again, you have the number in the middle, you have buy on one side, sell on one side, and you have a number in the middle saying either 0.01, 0.1, for example. So the rule of thumb we use is 0.01 for every £100 in your account. So if you've got £500 in your trading account or $500, you want to use no more than 0.05 per trade. So 0.05 means every pip the market moves, and we spoke about pip, unit of measure. Every pip the market moves, you'll make 5 pence or 5 cents. That's 0.05. 0.1, you make £1 or $1 every pip the market moves. 0.5, you make $5 every pip the market moves. 1.00, you make $10 every pip the market moves. 5.00, you make $50 every pip the market moves. We advise to stick to 0.01 per $100 in your trading account. And this is gold. Pips are measured different with different assets. So it's measured different with GBP, USD, NASDAQ, Bitcoin, all different assets. But we're going to just focus on gold. So it's a way of keeping track of your trades and your profits. And it's very important if you want to be a profitable trader, if you want to stay in the game for the long term, term and actually know what you're doing, you need to understand what pip is and how to count pips.